Hey, welcome to the Selling Stock Options webinar. My name is Andrew Ferguson from The Economist. Today we're going to talk about selling stock options, how you can do so to make a little bit of a side income for yourself, and just the metrics and actual strategy behind how to do it. Let's jump right in. What we're going to go through today, we're going to introduce the strategy. We're going to have a quick definitions of what stock options are to make sure you guys are up to speed with what they are, how they work, and what kind of pieces you have to remember that puts them all together. We'll go in depth about what selling puts means. That's a strategy that I use myself day to day to make extra cash for myself and create a nice little side income. And we're going to talk about exactly why this matters to you guys, why you guys are here, the major benefits, as well as some risk analysis with this strategy. And then I'll go through a live example just to make sure you guys have a visual of how the actual numbers work and how everything pieces together. And at the end, just make sure you guys stay tuned to the end. I've got some great little content at the end for you guys, different ways you can get connected, and one interesting and exciting thing coming down the pipe that I've been working on for a little while now. So stay tuned to the end of this and check out the wrapping it up section. But let's get into the strategy to start. And this is something that I do. It takes me roughly 30 minutes a day. Now, granted, I've been doing this for about a year and a half now. I've taken over 80 hours of training on this and read numerous books, listened to podcasts, and refined my strategy with coaching calls from some mentors as well. So I feel what is an advanced knowledge base, but I had no knowledge at all flashback a year and a half ago. So if I can do it, any of you guys that are listening to this can do it as well. It's just a matter of having the right mindset and being willing to take action to get there. But now I'm down to the point where I spend 30 minutes a day, 15 in the morning, 15 in the afternoon. I read some news, open my phone, execute the strategy, and away we go. The nice thing about this strategy is that you can do it from anywhere. You have a smartphone, you have internet connection, you're good to go. You can do it on your computer as well if you prefer, but I use my smartphone. It is mobile. I can do it from the grocery store. I can do it from the bank. I can do it while I'm in a passenger in a car. Anywhere you have Wi-Fi or data and your smartphone, you can use this. You can use the app and you're good to go, make some money. Really helps. Just keep it short and simple. I know the guys are busy. You guys have crazy busy lives, all you guys. So it is important to be able to do this efficiently and as quickly as possible to minimize the time you guys are spending worrying about this stuff. Get on with your day doing what you want to do. Yeah, and this is honestly just to create a secondary source of income. I'm a big believer in having more than one source of income. Having a job is great. Having 2 or 3 extra side incomes is even better. And you just become more diversified in how you make your money, and you give yourself better protection and better safety moving forward in your life. And just the high level, generally what happens in this concept is that either you're going to get paid for something and you're not going to have to buy any stock, or you're going to get paid for something and you're going to buy stock at a discount. Those are the 2 ways that this strategy works and pays off. And we'll go through things as we go through things. If you have questions, make sure you guys write them down and feel free to email them to me at the end of this, or shoot me up a message on Instagram. I'd be more than happy to answer questions for you guys and kind of keep you interested in the right direction here on selling stock options. So a couple of things you need to know before we get into an example. A stock option is a contract, and it gives an investor the right, but not the obligation, to buy or sell a stock at an agreed upon price and by a certain date. Now, it's important to know that there are 2 types of stock options. There are calls and puts, and you can buy a call, you can sell a call, you can buy a put and sell a put. So there's 4 different metrics there. And just to keep it really simple today, we are only going to be focusing on selling puts. Why? Because in my opinion, it is the strategy where you can actually limit your risk the best and also have a lot of known risk on the table. That's just what I think is the best. So we will go through this and I will show you the mechanics of it. But a couple other things you need to know before we do that is that when you go to buy or sell a share in a company, you can usually do sales or buys in 1 share increments. You can buy 1 share, 2, 3, 4 shares. Every options contract, though, is made up of 100 shares. So anytime you see a number, you have to, in your mind, multiply it by 100 to get the actual final value. And we will, again, look at examples. This makes more sense to you. But there's also something that's called the expiration date. And in every contract, right, there has to be a signed date where the contract is no longer valid. You can't sign something that goes on forever and ever and ever. There has to be a specified end date where either A happens or A doesn't happen, and that's defined by the expiration date. The strike price, that is the price that traders are expected, they're expecting the stock to be above or below by that expiration date. This is very similar to real estate. When you go to agree and buy a house, it would just be the purchase price. And in this case, it's called the strike price. So just become confident and comfortable with those terms. One contract is 100 shares. The expiration date is where it expires, and the strike price is the agreed upon price between both parties, the buyer and the seller of the options contract. Now, this is a standard options contract chain, and this is showing the Apple, which is AAPL. That's the ticker symbol for Apple. And as you can see, there's one side which is calls and one side has puts. And I like to live in this puts area only. I don't really dabble in here too much. I sell puts majority, I'd say 95% of the time I'm selling naked puts, selling put contracts and getting paid to do so. This up here is the expiration date, which we just talked about, December 31st. So at the time of recording, this is showing and projecting contracts that are available 13 days till expiration. So any contract on this page that you enter into, again, a call or a put, it would expire at 4 p.m., which is market close, on December 31st, 2020. And then here in the middle, we just see the strike price. And again, the strike price is the agreed upon price for a contract. Currently, Apple is trading at $127.91. And in most apps or brokerages, online platforms, they will show you a line here to just differentiate where the current stock price is. So you guys can visually see the stock price is right around this line where it turns to blue here and blue here. That's the line where it's currently trading at. So it's in between these two strike prices, and that's just so you guys know where the stock price is current to these different options contracts. Over here, we see a column that says bid and ask. Okay, and what this is defining the price that someone's willing to pay and someone's willing to buy. It's kind of like bartering for goods. If you went to buy something and like a used car and you said you want to pay $10,000 for it, and they said, well, we want you to pay $15,000 for it. Maybe you guys meet in the middle at $12,500. This is the same in stock options. This is what's known as premium. So the buyer of the contract has to pay this. The seller of the contract gets paid this. So there's an agreement that happens, and usually it is struck and the deal is struck somewhere between these two numbers. Usually if it was this one, it would be $1.82. These are dollar values. And usually the contract is executed at the midpoint of these two numbers, but that's just the premium, and we'll get into premium in a second. So those are the important things you need to remember: expiration date, strike price, put or call, and then obviously the premium that's going to be paid to the seller and paid by the buyer for every contract. Now, when you're selling naked puts, this is a strategy where the seller receives premium from a buyer. So the seller is taking on risk, and the buyer is paying the seller to do so. And the risk that the seller is taking on is that they are agreeing to be assigned shares at a certain price, at a certain strike price. Okay. This generally works best, or it does work best, when the seller is bullish on the stock that they are selling the contract on, or the company in general. In our example with Apple, if you were selling a naked put, as a seller, your mindset would be, I'm expecting Apple to go up in value, or at the very least stay the same over the next X amount of days until that expiration date kicks in. Again, once the expiration date is passed, the contract expires, and it either expires worthless or it expires and the seller has to buy shares. So for that time period, whatever it may be, the seller will be bullish on the stock or company and hope that they will go up in value. This strategy, again, it works best, and you guys will probably hear me say this a couple of times, but it works best when you sell naked puts on stocks that you want to own. Okay, let that sink in again. This is not speculative. This is not penny stock. This is about stocks that you want to own long-term in your account. These are the kind of companies that we sell naked puts on. So they're stocks you want to own long-term in your account or your portfolio. And this is what it looks like, the process of our timeline. What we're going to do at the beginning, again, is research quality companies you want in your portfolio. This doesn't have to be too big of a process, just creating a little watch list, maybe 10 to 15 companies that you really like, that you really know, and you can get behind, that you would want in a portfolio anyway. Then what happens is we go out and we sell naked put contracts on these stocks, on this set of 10 or 15 companies. And because we do that and we sell the contracts, we get paid a premium up front to sell the contract. As soon as you guys sell the contract, or someone sells the contract, they get paid upfront a premium that they get to keep no matter what. At the end of that contract, or by the expiry date, or on the expiry date rather, one of two things is going to happen. Either the contract is going to expire worthless, and the seller who took on that initial risk, they are going to keep the premium they got paid upfront, and the contract expires worthless. The buyer of the contract gets nothing, and they just had to pay for that chance that something might happen. If the contract is exercised by the buyer, the seller is then forced to buy 100 shares of a certain stock that was specified in the agreement at a discount. And what I mean by at a discount, you'll see coming up in an example, but there's two options here, and there's really not a bad thing, because sellers can generate income by selling these contracts, or what's going to happen, sellers can get assigned shares of stock at a discount. Those are the two options here. Those aren't those are win-win options. You either get income or you get stock that you want to own anyway at a discounted price. There's no real downside there unless you want to use the money for something else and it's tied up in these trades. But if you're here listening to this webinar, chances are you're looking for a better way to make money in the stock market versus just straight up buying and selling stocks or swing trading, something like that. So this strategy is great because even when you lose and technically get assigned shares, you still get to buy them at a discounted price. There are risks, but they are defined up front through the expiration date, through the strike price, by the premium that is laid out all in front of you and knowing which company it's going to be. And just as a precursor, there is always a chance that any company can go to zero. No company is 100% risk-free. If someone tells you that this company is too big to fail, they don't know what they're talking about. Any company, even if it's 0.0001% chance, there is a small chance they can go to zero. We try to limit that amount of risk by picking good quality companies, but just know that it is always a potential. But if you're investing in stocks, and I assume that most of you are or want to, that's something you have to get over, because any company that you buy straight up, that could happen to them as well. In this example, we're just looking at, or the strategy rather, we're looking at ways to define the risk up front so that we know what it is and it's something that we accept and we get a return for accepting that risk as a seller. Let's get into an example and go through it so you guys understand what we're talking about here in a little bit more depth. So we're back to our Apple example, and we have the calls and puts on the same side, same setup as before. Apple's trading at just under $127 per share. We think $127 is too much. We would be okay buying Apple at $122 per share. So what are we going to do? We're going to look at the strike price, and we're going to look at 122. We know now if we were going to sell a contract, we would have to buy 100 shares of Apple for $122 per share. This contract is going to expire on December 31st. So we know our risk level there is 13 days. And we know the strike price, that's defined, that risk is 122. So we're saying that we're going to sell that contract at $122. And what's going to happen is, because we're going to take on that risk, we're going to look at the bid ask. We're going to pick 124 right now just to keep things simple. We're not going to play the middle game there. We're just going to take the first number and go with it. In order to sell this contract, we are going to get paid $124. You see the 124, that is $1.24. And because there's 100 shares in each contract, you multiply 100 by 124. And what we're saying is we are committing as the seller to buy 100 shares of Apple at $122 per share, but only if the stock price is under $122 at market close on December 31st, 2020. We are taking on a risk of having to buy shares, but because we're taking on this risk, we're going to get paid $124 upfront when the deal is closed immediately. We get to keep that no matter what. Even if the shares, we have to buy the shares, we still get to keep that 124 no matter what. If the price of Apple on December 31st, 2020 is above 122 per share, if it's at 122 and 1 cent, the contract expires worthless, which means we get paid $124. We don't have to own any stock. We got paid that 124 for a period of 13 days, and now we are free to go out and do it again on Apple or any other company that we want to trade on. That's the beauty of this strategy. But let's say things don't go our way and Apple doesn't go up in value like we want it to. Let's say it goes from 127 currently and it goes down and it drops to 120 on December 31st. So now what happens? We now said, okay, when we originally did this, we said we would be okay buying 100 shares at $122 per share. Now it's happened. It expired at 120. That's below 122, right? 120 is less than 122. So we have to buy 100 shares of Apple at the agreed upon strike price of 122 per share. And that looks like 122 times 100. So we have to shell out $12,200 and buy 100 shares of Apple. The nice thing is here that we were still paid that 124 in the beginning in premium. So we can actually subtract that from the cost of shares and reduce the amount that those 100 shares actually cost us. The actual cost of those 100 shares for us goes from $12,200 all the way down to $12,076. And how does that math work? We're still going to have to pay the initial $12,200 to buy the 100 shares because of our 122 strike price. That doesn't change. What changes here is that premium, that 124 we got paid, $124 that we got paid up front in premium, we can subtract that from the total cost to buy the shares, leaving us with a total actual cost of $12,076. Again, that is the worst case scenario here. We get to buy stock that we want to buy at a discount. It went from trading at 127. Apple went on a bit of a dip, we're saying, and it went all the way down to 120. We decided to buy it and put a contract for 122. But in actuality, we almost paid about $120 per share when you take into the fact that we got to subtract the premium from the cost of actually buying 100 shares. So what we're now expecting is that Apple's a long-term company. We would just hold these shares until Apple gets above 122 per share. And then once it does, we can go turn around and sell them and make our money back. So Apple's a good company. It pays a dividend. Great. We're okay owning the shares. We would be okay owning these shares anyway because we like Apple as a company and we believe in them long-term. So in this scenario, you get to buy the company that you wanted to buy anyway, and you get to buy it at a discount. What are the risks? Well, we just went through it. In option A, the contract expires worthless and you get to keep the premium received. There's not a lot of risks there, and you're free to repeat the process over and over again once the contract expires. The other side of it is that if you are assigned shares, you have to buy them at a discount. And honestly, that's a pretty good deal when you look at all things considered. You're buying shares you want to own, and you get to do that at a discount. Again, any company could go bankrupt and their shares would become worthless in that sense, but that could happen to literally any company that is publicly traded. But this is why in this strategy, it works best when you use it on companies you want to own long-term in your own stock portfolio. That's how you limit your risk with this strategy. That's how you get paid to either sell contracts that expire worthless or sell contracts and buy stock at a discount. It is a win-win, in my opinion. The biggest risk that people have is that they use margin or borrowed money from the stock brokerage that they use. And what you're doing is essentially using all the money in your account plus borrowed money from the brokerage. And when you do that, you could potentially over leverage yourself. And what that means is you're opening yourself up to more and more risk the further you go borrowing money. One of the drawbacks to this method, if you want to do it safely, so it's not really a drawback, it's just a safety mechanism, is to not use any margin, don't use any borrowed money, and just use the money that you have in your account. Let's say you had 20,000 in your account. That means you have to limit yourself to selling contracts that add up to $20,000 in value. Our Apple contract we just looked at was the strike price of $122. If you multiply that by 100, you get a value of $12,200. In our account with 20,000, that means we'd have room for one more contract at a maximum value of $78 per share. You multiply 78 times 1,000 again, and then you have to add those two together. If those are at the same time, right? If you had one contract at 122 and one contract that you sold at 78, if you sold them and they were both open and they hadn't expired yet at the same time, that adds up, as you can see at the bottom, combined to $20,000. That would be the limit of contracts that you could sign at that time or sell at that time. So you'd have to wait till one of those contracts expired or they both expired to go out and sell a new contract. Otherwise, you'd be borrowing money and opening yourself up to additional risk. But as long as you stay below that $20,000 threshold, you have limited risk of having to own shares if you get assigned, or you have the risk of getting paid premium and the contract expiring worthless. One other thing, and this is true with any kind of investment though, is the opportunity cost of using your capital for selling naked puts versus investing in other platforms. You could take your money out. If you just buy shares, you could sell them right away and there's no waiting period there. You could liquidate immediately. If you sell a contract, you would have to wait till the expiration date of that contract if you wanted to potentially remove that risk and sell the contract back and close it off. You may miss out on some opportunity costs, but if you're in here and you want to make money in stocks, you have to be okay with that. At the end of the day, you do know the length of the contracts that you sign and you sell. So you do know how long you have to have that capital tied up. So it's not like it's tied up in a house or in some kind of business long term. Normally, I like to write my contracts in 4 to 5 week increments. So I know that that money is earmarked for 4 to 5 weeks, and then I will get it back and be able to use it for something else within my stock trading account. Again, just to reiterate, this is a strategy that I use 30 minutes a day, anywhere that I have internet from my smartphone, and it's been able to generate for me a 10% return over the past 6 months. If you annualize that return, it becomes 20% over the course of the year. The average return for the stock market, the S&P 500 index, is generally 10% per year. So right now, this year, I'm on track to double the benchmark, which is great for me. And I will take a 20% return every year. No questions asked. That's a great return in my books. With that being said, the better you get at this and the more time you put into it, the larger your returns can be. And obviously you want to start small and scale up from there. If you can invest and spend $100 and make it profitable for yourself, then you can go up to 1,000, then 10,000, and so on and so forth. I use this to create a secondary income stream for myself. And again, I'm only a year and a half into this, but I have a great concept and grasp of what the process is and how it works. And I've used this to, again, a 10% return over 6 months speaks volumes, especially in a choppy market that we've seen a couple pullbacks here in 2020. So if I can do it, you guys can do it. You just have to have the mindset of being those that want to learn and want to learn a life skills, honestly, that's going to help you guys long term. Once you get this and once you guys understand the concepts, it will be a lifelong skill that provides you income from your smartphone in less than 30 minutes a day. Start small. You can actually start in a paper account, which is fake money. That way you don't put any of your own capital at risk. You can define your system. You can learn how to trade. You can learn how the apps work and the systems work. And you can practice before you get comfortable enough to risk real money. And obviously, nobody's perfect. I've made losing trades. Professional traders make losing trades. But wouldn't it be better to take control of your income and not have to pay someone to manage your portfolio for you? Once you get to that point of comfort, you're in control, you're in charge, you know what you're buying, you know the companies that you want. You don't have to pay somebody else to go there and make decisions. And the worst thing that I see is that people have these accounts managed by professionals, and those professionals get paid no matter what. Even if their clients don't make money, the professionals still get paid. And that drives me crazy why you would pay someone else who can't even generate solid returns for you. Why not take some time, invest in yourself, and take control of your investing, learn a life skill that'll make you money long term. If you guys do want to know more, check me out on Instagram at The Economist. You can check out my YouTube page as well, my channel. You can check out the blog at www.theeconomist.com. You can send questions to my email, andrew@theeconomist.com. And make sure you guys stay tuned and check your emails for a special upcoming offer on my online e-course. I'm going to focus specifically on this strategy, how to get your account set up, how to choose companies, how to execute the strategy with proficiency, reading charts, and maximizing returns, all in the effort to teach you guys this life skill that I've learned that I want to share with you. I'm all about education and furthering your education to create wealth in your life. So I want to share this with you guys. Please, if you guys have any kind of questions or feedback on this webinar, I would love to hear from you guys. Drop me a DM on Instagram, send me an email, and stay tuned for more content from The Economist. Thanks for checking in, guys, and keep investing in yourselves.